Metro Manila offices enter 2026 in a landlord-tenant tug-of-war, with vacancies seen improving to 18.9% as demand strengthens and leverage narrows. Rachel Unwar of Cushman and Wakefield breaks down what this means for occupiers and landlords. Rachel, welcome to the discussion. What is driving the current landlord-tenant tug-of-war in Metro Manila's office market?
I describe Metro Manila office market right now as being in a phase of adjustment rather than clearly favoring landlords or tenants. Vacancy levels are still relatively elevated. We ended at about 18% vacancy as of Q4 2025. And this comes after several years of new supply and space being returned to the market. So competition among buildings remains healthy, especially outside the main CBDs. I think there are three key points I'd like to highlight here. So first is that hybrid work has really changed how occupiers think about their offices. They are taking on less space overall, and they're focusing not only on the cost, but more importantly on quality, flexibility, and long-term alignment to their sustainability objectives. Now, second is what we're seeing in Metro Manila is a two-speed market. So the shift in the workplace strategy has created a more polarized market, where in primary CBDs like Makati, Bonifacio Global City, and Ortigas, demand has been steadier, and we're already seeing single-digit vacancies. In contrast, the fringe areas in secondary business districts are pulling overall vacancies upward. Which brings me to my third point, which is that the real story is in negotiations. While headline rents may look very stable across the board, the negotiations with landlords in secondary CBDs are more active since they are highly motivated to retain and attract new tenants. So overall, I think it's a very selective market, and outcomes are highly dependent on location, building quality, and how well, at the end of the day, these spaces align with the current workplace objectives of tenants.
And how are landlords adjusting strategies to retain tenants amidst high vacancy rates?
So we expect vacancies to continue to rise or still be elevated within the next couple of years due to high volume of incoming supply. But mostly, as I mentioned, these will be located in the secondary business districts. So the landlords in the affected submarkets are more open to negotiating provisions around lease flexibility, longer fit-out periods, and incentives to lower effective rents. So based on our data and transactions, recent transactions, achievable rents are as much as 15 or to 20% below headline rents for renewals and new leases. And in contrast, competition we're seeing is getting tighter in grade A offices, especially those that are located within the prime CBDs. So here, landlords have been more successful in unlocking the value of the flight to quality trend that we're seeing from occupiers. They are offering future-ready building specifications, stronger sustainability credentials, and also amenities that are better suited and supportive of today's workplace expectations.
Now, Rachel, I'm sure our viewers would be interested to know, do tenants now really have greater negotiating power in certain office districts?
And tenants do have a greater negotiating power in secondary districts such as Quezon City, Parañaque, Alabang, and in the fringe areas of the major CBDs. That being said, though, even with overall vacancy levels remaining elevated, negotiation leverage really comes down to the specifics of the situation. So we need to consider who the landlord is, the quality of the building, current vacancy of the building, the tenant profile, and of course, timing. Timing in particular is a critical factor, I would say. So we're currently advising many occupiers on a stay versus go strategy. And in these cases, going to market early, ideally at least 12 to 18 months before lease expiry, allows tenants to maximize their negotiating leverage and build a well-rounded strategy after fully assessing all the available market options. So to that point, landlords of aging buildings are competing with newer buildings to retain their tenants. So we see a lot of flexibility in renewal negotiations now, especially in markets where tenants are already paying way above the fair market rent, considering new leases.
Well, thank you very much for your time today and joining us, Rachel.
Thank you, Simon.
Once again, our guest was Rachel Engwa, Director and Philippines Hub Lead at Asia Pacific Tenant Representation at Cushman & Wakefield. For more news, please visit realestateasia.com.